All right, welcome to chapter 2. We're going to look deeper at the balance sheet in this chapter. Matter of fact, the purpose of today's class is to look at what the balance sheet is formally. It's called a classified balance sheet. So you're going to be learning about what this classified means in a classified balance sheet. So you've already been introduced to a balance sheet, right? And you already know that a balance sheet has assets listed on one side, and it will equal the liabilities plus the stockholders' equity on the other side. And you've already gotten a taste of that from chapter 1. Now, what you might not have known is actually because there are so many different types of assets that accountants have had to go ahead and classify assets, which means they sort of group similar assets together. They do the same thing for liabilities, but they don't do it for stockholders' equity. So let's focus on how they classify things. Now, first of all, remember that a balance sheet is a financial selfie. In other words, the balance sheet will simply have the date on it, right? So as of this date, these are our assets, these are our liabilities, this is our stockholders' equity as of that date. It's going to be different tomorrow, and it was different yesterday. So that's why balance sheets use specific dates. It's a selfie, right? Get your cameras ready, take a selfie, because it's a financial selfie of the corporation that day. Well, it's interesting to know that we need to classify or group similar things together. So the first, I'm going to show you the broad group here. The broad group is assets are either what we call short-term or long-term. Short-term in accounting speak is what the word current means. So, and you see short-term assets are referred to as current assets. Short-term liabilities also use the same jargon. Current liabilities are short-term liabilities. So the word short-term specifically in accounting means periods of time no longer than a year. So a short-term or a current asset is a resource of a business that's either going to be converted to cash within this year or used up within this year. So that's a current asset. A current liability is a debt that would need to be paid this year. Now, remember, when I say this year, I'm looking at the date on the balance sheet. So today is February 1st, 2021. So if I have a debt that is going to need to be paid between today and February 1st, 2022, 1 year from today, it's going to be a current liability because I have to pay it within the year. Okay. The same thing is true when I use the word current assets. Current assets are resources that I own today, February 1st, 2021, that are either going to be turned into cash or used up within the year. So the current part refers to the year. And we know what's the year because the balance sheet has a date on it. So a year from that date is how we look at current. So if current simply means less than a year, which we consider short term, then long term means more than a year. And so that is also true. More than a year from the date on the balance sheet. Again, that date on that balance sheet, don't take it for granted because it's a marker that we use to determine what's current and what's long term. Okay. So a long-term asset, there are lots of them, but they are resources that the company is going to use for the long term. And again, that means over a year's time. Could be well over a year, could be 5 or 10 years, could be 20, 30, or 40 years, but it's over a year. It doesn't matter. It's just over a year, long term. Long-term liabilities, again, debts that are owed over a year. Again, a year from the date on the balance sheet. So if a debt is not owed until 2 years from now, it's a long-term debt, a long-term liability. And so again, long-term and current, long-term and short-term, less than a year, more than a year, that these are all things you have to put together when we talk this type of jargon in accounting. There are lots of assets, and so even though there are lots of long-term assets, we have to classify them or group them based on what they are and what they do. So let's focus on the assets for a moment. All companies, by the way, that you see every single company has current assets. No ifs, ands, or buts about it. That's not always true for these other groups or classifications of longer term assets. But all companies, I will tell you, have what we call property, plant, and equipment. Property, plant, and equipment. These are long-term physical assets, so they have a physical quality to them, that are used in the business. Okay. So let's say I run a pizzeria, Mike's Pizzeria. Okay, so I have a lot of property, plant, and equipment. Let's take a look at the terms and I'll apply it to my business. So property, in essence, older term, land. Okay, land is pure and simple property. Plant is an older term, meaning factories or buildings, things like that. So when I say plant as part of property, plant, and equipment, I'm talking about any buildings that I have, right? Equipment is probably the largest definition here because it literally can mean equipment like my pizza ovens or my refrigeration system. But it can also mean a computer system. It could mean tables and chairs, what we call furniture and fixtures. It could have a delivery truck that could also be classified as equipment. So equipment is a pretty big category. A lot of things fit under equipment, at least the way it's applied in this particular class. That's how you're learning it. And so every company will have property, plant, and equipment. They will have current assets for sure, and they will have property, plant, equipment for damn sure. Those two categories or classifications of assets you will see on every single balance sheet, I guarantee it. What you may or may not see are these other long-term assets that are classified. One that's becoming more and more common, this one at the bottom here, called an intangible asset. Now it's interesting because the word intangible simply means you can't touch it. So property, plant, and equipment, you can touch the land, you can touch the building, you can touch the ovens and other things in my pizzeria, the tables and chairs, the cases, etc. But an intangible asset would be, for example, things like patents, which means I am the recognized owner of an invention, or a copyright, which again means I'm the recognized owner of a piece of writing, a piece of music, or a piece of software, or something like this. Or I have a trademark because my little Mike's Pizzeria has its own little fancy guy flipping a pizza, and I own that as a trademark. No one else can use that. Those are intangible assets, or examples of intangible assets. And intangible assets in general basically are not something you can touch, because how can I prove to you that I own an invention? Well, I have a patent, which is basically a piece of paper from the government recognizing me as the legal owner, right? So in that sense, it's an intangible asset, different from property, plant, and equipment, because you can see my building, you can see the tables and chairs, you can see the ovens, you can see my refrigeration equipment, etc. You can see all that and you can touch them. The intangible asset, you really can't, but it's something I'm using for my business and it's helpful. So more and more businesses actually have intangible assets that they're using because in some cases, the entire business is built around an intangible asset. Like, for example, a patent for a drug, the vaccines that are happening now um, in society. These are pharmaceutical companies that have applied for a patent for their invention for a vaccine, and the government recognizes them as the sole owner of that particular drug. And so they're the only ones who have the permission to make it and sell it. If someone else tries to make the exact same drug and sell it, they could be brought to justice. They could be brought to court. Same thing with copyrights. If you try to make, if you try to pose as a specific Disney character, which all those characters are copywritten, they're owned by Disney through a copyright. And you didn't get permission from Disney, but you still used it in a film or whatever costume without permission, they could sue you for that because they own it and you didn't ask permission in the form of a fee usually. So copyrights are extremely important assets. Patents are extremely important assets. Trademarks are extremely important assets. You can't use, for example, the NFL symbol without permission, written express permission of the National Football League. You can't make a jersey, whether you like Brady or not, about him with anything to do with Tampa Bay without permission because you don't own that. They do, and you need their permission to use it. So it's these are very, very important assets for companies. But again, some companies have them, some companies don't. The last category or classification of assets that that are listed here is something called a long-term investment. And a long-term investment basically is a long-term asset, but it's not being used right now in the business to generate revenue. So, for example, Walmart sells goods. They have stores, they have shelving, they have all types of other stuff to help them sell those goods. Excuse me. Walmart might also decide to purchase stock in some of their suppliers. So they bought stock, shares of stock in a corporation, that's their suppliers, and they own those shares of stock, and it has a value. So they own it, so it's their asset. But it doesn't help Walmart sell goods, which is their business. So it would be a long-term investment. For my little pizzeria, let's say I wanted to expand my business and I'm thinking ahead, and there was a building that was for sale, it was empty buildings for sale, say in Newburgh, and I wanted to buy it because in the future I want to put my pizzeria there as well. I want to put another pizzeria there. So I bought the building and I own it, but I don't have anything going on there. It's just an empty space right now. It's not open, it's not selling pizza, nothing. It's a long-term investment for me because I own it. I will develop it into a business, but it's not generating any sales of pizza. So I can't say it's property, plant, and equipment yet. It's a long-term investment. So these are how we would classify things. It's a little easier on the liability side. Clearly, there's only two, current and long-term, and you all know liabilities are debts. So it's a little bit easier to sort of make that out. Your book here splits up Learning Objective 1, focusing first on all these assets because there are 4 different classifications of assets here. And there's a number of them that you need to know. So let's take a look at them. Your book has a company called Franklin, and as of October 31st, this is what their balance sheet looks like. Now, this particular part of the balance sheet only shows assets in a classified way, right? Your current assets are listed first. Long-term investments are listed second. Property, plant, and equipment is listed third, and intangible assets are listed fourth. This is how it would be this is how it would actually be on a classified balance sheet for any corporation that had all of these. Okay. Now, like I said, every corporation you're ever going to look at has current assets and property, plant, and equipment for sure. That I can guarantee you. Okay. But not everyone else has the other categories. So let's take a look at your current assets. These are all the different accounts. Remember, in accounting, for accounting to make sense to anybody, you got to understand the accounts. So let's look at them. You've already been introduced to many of them. You know what cash is, right? Your main bank account. You already know what accounts receivable, right? You're waiting to receive money because you've already made a sale. You already know what supplies and prepaid insurance are, right? And so you've been introduced to a few of these already, okay? What you might not have been introduced to, we're going to go over. So I think actually you might have been introduced to inventory as well. So inventory is the goods that are owned by the store before they sell them to you. So you walk into Walmart, you see all the different products on the shelf. That's their inventory. But the reason they have that inventory is because they want to sell it to you. So that's simple. So let's take a look at these other two that are a little bit more interesting. The first one that's listed here is something called a debt investment. I don't want you to get confused by the word debt. Okay. Because as an investor, and a lot of you may want to be investors, some of you might already be investors. As an investor, you really only have two choices as an investor. You can either own something or you can lend money. Okay. That's really the only two ways you can invest, basically speaking. You're either going to be an owner or a lender. And so when you lend money, that is called debt. And since you own it, that is a debt investment. Okay. So basically speaking, that's what a debt investment is. How it works in life here, it's right next to cash because oftentimes debt investments are actually offered right at your local bank in the form of a money market account, for example. So a money market account simply is an investment in short-term debt of banks, short-term debt of the government. So that's what the money market accounts are. That's what the money market is, and that's what a money market account is. So even though it's called a debt investment, you own it, right? But you're lending your money in that investment. So it's a debt investment. Debt investments are very common, very, very common. And they can be turned into cash very, very quickly in 24 hours, very, very quick. You already know about accounts receivable. Accounts receivable is you're waiting to receive payment because you've already performed the service or sold the product and you're waiting to receive your cash. Right? So accounts receivable will turn into cash. So that's why it's listed here. Some businesses, and again, accounts receivables are business to business transactions. One business sells another business something and says, okay, here's an invoice. I'll wait to receive your payment later. That's usually a 30-day wait, no more than 30 days. Some businesses, however, need more time to pay. I can't pay in 30 days. I need 60 days. I need 90 days. I need 120 days, what have you. And so what we would do is say, fine, I'll give you 120 days, but I'm going to charge you interest, okay, for that period of time. So you can pay me 120 days from now, but it's going to be that payment plus interest. And that's basically what a note receivable is. That's it. It's simply an accounts receivable, which you would normally just collect in 30 days without any interest. And you've made an agreement to make it a loan for a longer period of time with interest. That's it. And again, it's a current asset, so that longer period of time was not going to be years and years and years, right? So it's going to be usually in a period of 30-day periods, 60, 90, 120 days. It's usually a 30-day period of time that they usually work with. Okay, and that's all your current assets, but these are all the current asset accounts. Current assets are always totaled. So what you'll see in the far right column are the totals of each classification. This $22,100 is the total current assets, all these accounts added together. Long-term investments are listed next as they would be on a classified balance sheet. Now here they have what they call stock investments. So here you learned about debt investments as you investing in debt. Guess what the stock investments are? That's when you invest in literally stock, right? Shares of ownership in a corporation. Those are the only two investments you can have, by the way. You could be an owner or a lender. So basically speaking, this is the company, Franklin, owns shares of stock in these other companies that they plan to hold for longer than a year. They plan to hold them longer than a year from this date. Okay. So that's why it's a long-term investment. Notice they also have an investment in real estate. And again, it's just they might own land, they might own a building, God knows, but they're not using it right now. So it's a long-term investment. It's listed here. So here, this total here is the total of the long-term investments that this company has. The third classification, property, plant, and equipment. Again, older terms, but they do have a lot of meaning. Property, simply land. Plant, simply buildings or factories, right? And equipment, very big account because a lot of things can fall into it. So because property is listed first, land is listed first. Now, land is good forever. Okay. Land is something that once you own, you own. And since the earth has been around for, depending on what you want to believe, X number of billions of years, you can say land is going to be around for a while. Okay. So land is something that's always useful for any business. So land is going to be considered the very first part of property, plant, equipment. However, businesses, whether they do buy buildings or they do buy equipment, have an issue as soon as they buy it because it's not going to last forever. Unlike land, which will last an infinite amount of time. When you buy a truck, delivery truck, it's only going to last a certain amount of time. When you buy a pizza oven, it's only going to last a certain amount of time. So when you get to plant and equipment, you have this issue of what we call a useful life for the business. And the question becomes, how long is this asset going to be useful for the business before it has to be repaired or replaced, basically, is the choices you have down the road. So normally you would be buying equipment for a long period of time. Could be 3 years, could be 5 years, could be 10 years, depending on the equipment. And you will use it specifically to generate whatever you're selling. So, so it starts off with a value of purchasing it, but because equipment is only going to be good for a certain period of time, it goes through a process called depreciation. Depreciation simply is, again, since the equipment is only going to last us, say, 5 years, example, that means that after that 5-year period of time, we're either going to have to repair or replace that equipment. It's not going to have any more usefulness to the business to help us make money. And so over that time, we can depreciate the part of the equipment that we're going to use for the business. And so that's really the depreciation. It's a very, very slow way of expensing a long-term asset over time. Okay. The accumulated depreciation simply is the amount of depreciation we have already expensed over the course of its life so far. So this $24,000 piece of equipment, we've used it because we have already deducted $5,000 of depreciation from it over the time we've used it so far. That means that this $19,000 figure here is the difference between what we paid and what we've used so far. This is what a book value is. And you're going to see this term a lot. This is the book value of the equipment. And a lot of people, you might be interested in buying a used car or use other thing. And one of the first things you look at is what's the book value of this? And this is how they do it. What it costs new, subtract out the amount of depreciation. How much of it has already been used because it's not as useful anymore as it used to be when it was brand new. So the book value basically tells you what's left of its usefulness, what the value is of that. And so here, this 29,000 is simply the total property, plant, and equipment, the land plus the book value of the equipment. The last thing that's listed here are the intangible assets. Here, this particular company has a patent. A patent, and again, is the government recognition, official recognition, that you own an invention. That invention might be a pop-off bottle, might be a drug, might be, a MacBook, because Apple's got a lot of patents as well. But it's an invention, and it's a recognition, official legal recognition that you're the owner. Okay. So they have a patent, so they created something. And then they have total assets here listed at 61,400. But again, the important thing to understand here is a classified balance sheet has this structure. Current assets are always listed first, long-term investments, if any, next, property, plant, and equipment, next, and intangible assets, if any, are listed last. Okay. A little less problematic on the liability side, because there's only two categories. Current liabilities, debts that are due this year, right, within a year of the date on the balance sheet. Remember, current within that year. That's what the date is there for. Okay. Long term, more than a year. So you already know all of these current liability accounts because they were part of Chapter 1 already. What you've seen is some of the long-term liabilities that you may not be too familiar with. A mortgage simply is a loan on a piece of property, a building or property, and those loans tend to be for many years. It could be 10 years, 20 years, 30 years. So a mortgage payable, that's the account name, is a long-term debt, so it's a long-term liability. Now this is interesting. Here you have notes payable, and here you have notes payable. How can they be listed twice? Well, because some of these notes, remember, a note is a loan. Some of these notes are due within a year of this date. Well, 11,000 are due by a year from that date. And clearly a little portion of that, this 1,300, is due to be paid after that year. And that's why it's split up. Portion that's due now, portion that's due later. Stockholders' equity doesn't change. It's the same. It's not broken. It's not into classified. These are the same two accounts you're going to see in stockholders' equity over and over and over again. Okay. So your book goes over this with some examples. This is from Southwest Airlines and their current assets. Again, current assets are always totaled as our current liabilities, but they're all going to look very, very similar than what you've already seen here. Long-term investments, Google has some stock that it owns on that particular balance sheet. Property, plant, and equipment, this is from Tesla, which has a shitload of property, plant, and equipment, as you see here. And so lots and lots of things. And of course, they also subtract out their depreciation as well to get a book value of all of that. And the intangibles here, as I mentioned, Disney has a ton of intangible assets because they own all the characters, right? So, and they own a lot of characters. This is not just their traditional, Mickey Mouse, Winnie the Pooh, things like that. They bought Marvel, so they own all the Marvel characters. They bought the Star Wars group, and so they own all of the Star Wars characters. So that's how they make money. So this is an incredibly important asset for Disney. And so these intangible assets are extremely important. Okay. So this particular part of the chapter breaks it into 1A, 1B. And because the asset section has 4 different classifications versus the liabilities, which only have 2, and it makes sense. This particular and a couple of your questions for homework focus on the asset section. So remember, current assets are always first. And then if a company has long-term investments, that would be next. Property, plant, and equipment is after that, and all of them have it. And then if they have intangible assets, they're last. So here we have Baxter Hoffman and Hoffman Corporation. These are the numbers as of December 31st of 2017, and they want you to prepare simply the asset section. So asset section, current assets always go first. So you have to then identify, and this is one of the things you're going to learn, identify your current assets. So prepaid insurance is a current asset, cash is a current asset, receivables are current assets, and inventory are current assets. So you identify the accounts, and then you say, okay, current assets have a specific order. When you look at the Franklin page, you'll see cash is going to go first, receivables will go second, inventory will go third, prepaid insurance will go fourth. That'll be the order of the current assets. Property, plant, and equipment is going to go first. Accumulated depreciation is going to piggyback right on that, okay? Because that's how much of that equipment they have already expensed through depreciation. The difference is going to be the book value of the equipment. So when you actually see this written up on a balance sheet, here you have your current assets in the order I had mentioned. Total current assets are here, 7,400. Your property, plant, equipment, your equipment minus the depreciation on that equipment gives you a book value of 8 grand. Those two together is your total asset side. This only asks you for what are the total assets. Right. So that's one of the things that you're going to be doing here. The other thing here is being able to identify things. So here this part of the chapter goes over, gives you Google's current liabilities, and they're all going to look very similar. This is Nike, and they have long-term liabilities. Here's something that you haven't seen yet, but it's a very important account to know. A bond is a loan from investors, okay? So investors go to the stock market to own shares of ownership in a corporation. Investors go to the bond market to lend money. They lend money to corporations and the government, both federal and state. So the bond market's very important. So a bond is a loan from an investor. So bonds payable are loans from investors. These are long-term loans. The bond market is a long-term lending market, okay? So Nike has a bond payable, okay, as well as a note. So note that. And of course, no change to common stock. Okay, I mean stockholders' equity, common stock, retained earnings. So those will always be the same two accounts, and there's no need to classify. So here we go. This is the other part of this chapter, which is this example. You have to know what the account is classified as, okay? So you've just learned assets are classified as 4 different ways. Current assets, right? These are the ones that are either going to be turned into cash within a year or used up in a year. Long-term investments, these are assets that are owned by the company for the long term, which means over a year, but they're not being used right now in the company. Property, plant, and equipment, these are the physical assets that are being used right now, and they're going to be used for several years because it's long term. And that's PPE. And intangible assets, right? Assets that are very important to the company, but they don't have a physical quality like a building or a piece of equipment. They're basically proof of ownership in something intangible like a character, like a copyright, or a patent for a pill or another invention. Current liabilities, debts that are owed within a year. Long-term liabilities, debts that are owed outside of a year. And of course, stockholders' equity. This is the classified balance sheet. However, you may see some items that are going to be on the list that do not belong on the balance sheet. And if they do not belong on the balance sheet, they get a big Nah. Now, I know it's NA, but I like to just put a little spirit into it. So I'd say it's nah. Okay. Yes. No worry. I've taken my medicine today. All right. So here we go. Classified balance sheet information. These are all the accounts, and you have to classify them. Woohoo! All right. So get ready. Salaries and wages payable. So the word payable, by the way, is associated with a liability. Right? So you think salaries and wages. If you owe salaries and wages, how long will you be paying it? Less than a year? Over the year. I'll tell you, if you're waiting over a year to pay your employees, you're not going to have any employees. So this is going to be a current liability. Yes, yes, yes. Service revenue. This is interesting because service revenue means I've earned money by providing a service. And if I earned money by providing a service, it does not belong on the balance sheet. So this is going to be nah, which is the same way of saying it belongs on the income statement. Okay, belongs on the income statement. Interest payable is interest that I owe on a loan. That's payable. So obviously the bank's not going to be waiting for a long time for that either. So this is also going to be a current liability. And the word payable indicates I need to pay it. Goodwill is a type of intangible asset that reflects a company's overpayment for something when they buy things. So when Disney bought Marvel, just like when you buy any asset, you're looking at the value on the books of an asset. When you pay more than that value, the additional you pay is something called goodwill. So the characters that were on Marvel might have had like $1 billion value. When Disney went ahead and paid $5 or $10 billion for that, the additional amount over that what they were worth is goodwill. Depreciation, so that's an intangible asset, right? Depreciation expense. Now this word should tell you what type of an account it is. It's an expense account. If it's an expense account, it belongs on the income statement. And so this is also nah. Here's another payable, but this is a mortgage payable. So remember, a mortgage is a long-term loan. And so if it's a long-term loan, this is a long-term liability. Yeah. An investment in real estate. So you own it, clearly, but you're not using it. So that makes it a long-term investment. Equipment and accumulated depreciation on equipment go together. So this is part of property, plant, and equipment. That's the classification for equipment and accumulated depreciation on equipment. A debt investment is an investment that you made in debt. If it's your investment, you own it. So it's an asset. And if it's a short-term asset, it's a current asset. Retained earnings is simply a stockholder's equity account. So it belongs in stockholders' equity. And unearned service revenue means the customer has paid you up front and you owe the customer what they paid for, which makes it a current liability. Click on the next slide and boom, there it is. Now, of course, all these are given to you in your book as well. So it was really no mystery. I was just sort of making a game out of it. So that, my friends, is the lesson today. Questions?